And welcome to ETF Edge, your go-to place for everything exchange-traded fund. I'm your host, Bob Pisani. We're all coming to you virtually today. I'm joined today by Ed Rosenberg. He's the Senior Vice President and Head of ETFs at American Century. And John Davi is the CIO at Astoria Portfolio Advisors. There he is. Nice backdrop there, John. Nice home. Good for you. John, let me
Thanks,
start
Bob. Good to see you.
with you a little bit. Things are a lot different, John, than they were 10 days ago. The volumes seem to have dropped rather notably in some of the big ETFs like SPY and IWM. They seem to be about 30% lighter. Volatility is dropping. If you look at the VIX ETFs like VXX, not only are they declining, along with the VIX, of course, but we're also seeing trading volumes a bit lower in those as well. John, what are you seeing in the ETF market right now? Just give me 30 seconds of what your overall observations are.
I think things are normalizing a lot more. So bid offer has come down. I think that, the Fed with their announcement that they are dropping interest rates, to basically 0%, buying corporate bonds, buying more treasuries, that really kind of helped dislocate, provide some stability to a lot of the dislocations that we're seeing in the marketplace. So I'm encouraged by the price, encouraged by, more orderly markets as opposed to a couple of weeks ago when things were really, really kind of wide. So I think overall, things feel a little bit more normal. I know the economic front is going to look pretty bad and it's going to look real ugly in terms of unemployment claims. But price action and ETF front have been encouraging. And then not only that, Bob, but there's actually been more inflows into ETFs too. So, Vanguard took in a bunch of money in Q1. Yeah. And I think, shows that the retail investor has been kind of hanging in there for the most part.
Okay. Ed, would you agree? I know it's a little broad to ask, is the worst behind us, but give us your 30-second take on what's going on right now.
I mean, I'll agree with what John said. I've definitely seen spreads come down and the market's calm while volumes have been dropping. It seems that the market just needed some time, what I'll call, to settle into the reality of what's going on. And as we go forward, I think investors have started to take into account, the potential issues that, with all the stay-at-home that we've been in, what that actually means. And so they're looking for signs here and there to jump back in. But I do believe that the market itself has settled, and we've noticed spreads have settled into not what they were before this started, but to a very reasonable level with where the VIX is right now.
Yeah, I would agree. Ed, I want to talk to you about your recent product launch here after months and months of discussion. American Century, you guys became the first fund to launch what do we call them, I guess now, ANTS, active non-transparent ETFs. You launched American Century Dynamic Growth, American Century Large Cap Value, two of these funds last week. I want to remind everyone, unlike most ETFs, these ANTS do not reveal their holdings on a daily basis, and that's the major point here. Ed, congrats. You look like you're the first one out of the gate on this one. Tell us about these two funds and how they are trading. I mean, they only started just towards the end of last week, right?
Yeah, so let me jump into how they're trading first. I mean, they've been trading well, quite honestly, right off the bat. If you look at the products themselves, we're talking about, the first day, they each traded over 100,000 shares each. And spreads have been at a good level, 23 to 26 basis points since they've launched. Friday, they each traded reasonably well as well. And the nice part about this is spreads have maintained. There's been investor interest as they slowly get up on platforms. And so we've been buying. People have been buying. For focused dynamic growth, it's a concentrated large cap value portfolio. So it's going to own, call it 40 to 60 stocks, and its expense ratio is going to be 45 basis points. For the focused large value, go ahead, I'm sorry, please.
Go ahead, finish your point.
I was going to say focused large value is the same type of concentration, 40 to 60 securities, and that one's going to be priced at 42 basis points. And again, it's looking for value out there, looking for stocks that can lean towards a higher alpha portfolio while they're concentrated.
Yeah. And the key point is there is a sort of mirror fund for these. You have a mutual fund that essentially owns all of these as well. In this case, it's simply an ETF platform that you have out there. But there is an actively managed mutual fund that's sort of the mirror of these as well. Is that a fair way to describe it?
For focused dynamic growth, it's hard to call it a mirror, but yes, there's a very similar strategy. The fund itself will own different things because it owns international, while the ETF, this construct, the SEC hasn't approved any international holdings at the moment. So it's going to be a little bit different, but similar in strategy. For large value, we don't have a fund that's targeted towards this. So it's a newer strategy. So that one's going to be a little bit different.
So, John, let me just sort of move on about the whole philosophical point about ants, the fact that they are essentially active fund managers in a mutual fund space are migrating or at least moving over to the ETF space. And I guess, John, is this the last stand for active management? We all know they've had a very rough time of it for almost the last decade. Will a large portion, do you think, of actively managed mutual funds eventually migrate to an ETF space?
There's a good chance, a good probability that that occurs. I mean, I think a lot of those mutual funds that were bought, years and years ago, they're not sitting on embedded gains anymore, most likely. So I think now would be the opportunity for, a financial advisor to sell their, actively managed mutual fund to buy, let's say, an ant product. I kudos to American Century for being first to market. That's usually what you want to do. I think that, for my money, we prefer a little bit more transparency than less in general. But I'm always amazed about the ETF product. I've been working in the ETF ecosystem for 20 years. I remember when iShares first launched 25 ETFs in one day, people were like, why do you need a single country? Why do you need a subsector ETF? And sure enough, we have an entire industry now. So, there's always a market. And, what I would say is that, if what you saw in the last month is just the dominant force in terms of, being able to kind of, be more forward-looking, price discovery, true indicator of what the net asset value is. I think the mutual fund industry is in trouble, obviously. Just my whole business is based on the ETF ecosystem. So we're pulling for Ed and his team.
Yeah. So, Ed, do you have I don't know if it's a fair question, but do you have a horse in this race? Does it matter to you whether the mutual fund platform migrates over to the ETF space or not? I mean, how does the industry feel about this overall?
I mean, from our perspective, we want to offer the investors choice, right? So there are clients who are going to prefer mutual funds. It's just their normal habit, whether it's been dollar cost averaging or 401ks or 529s. There are other investors who want more control. And those are the investors that we're going to be targeting, right? And so for us, we want to make sure we give the investor the choice of vehicle that they want to use. And if you look across, there are a lot of advisors who are starting to prefer ETFs more and more for the flexibility and the benefits they offer, whether it's tax efficiency or whether it's trading intraday. And so the other thing you'll notice, Bob, is what's been happening with the headlines is ETFs are beginning to look more and more like mutual funds, whether it's platforms waiving commissions or allowing fractional shares. So there's going to be a point where they become a level playing field, and ETFs with their benefits could outweigh those of mutual funds in the long term.
Right, and here we see the holdings. Now you don't publish because they're not disclosed every day. We don't know what's in the ETF, but this is what's in the big holdings that are in the mutual fund, right? And it looks like standard growth stocks here. But just tell me what the cost is, by the way. What's the cost of owning the mutual fund versus the ETF?
So the lowest share class we have on the mutual fund is 65 basis points for focused dynamic growth. For the ETF, it's 45.
Okay, so it's at least 20 basis points lower. And they don't, the top 10 come out monthly, is that right? I'm just trying to figure out now how often we will find out what's in these funds. The top 10 come out monthly?
So the top 10 will come out monthly, and they're a large percentage of the holdings, so you'll be able to see those. Because the first seeding date, which is the official date, was March 31st, we'll be able to see the actual fund holdings for both 15 days after quarter end, which will be the old tax day, April 15th. The other thing, Bob, I do want to point out, which is interesting, is I was checking with some of the main websites that publish the holdings of every ETF and asked them what percentage of people that visit the site actually look at the holdings, and it's way lower than I anticipated. They said it was only 15%. So if you eliminate the people that really look for holdings, this is just an ETF to everyone else.
Right, I know. That's the argument. People don't really care that much, but I think a lot of people do here. John, I'm wondering how much pressure these ants, so-called ants, are going to put on the fund industry as a whole. So if ants become big and a lot of active mutual fund managers migrate to the ETF space where there are lower fees, I mean, these higher fees mutual funds pay for a lot of businesses. They pay for a lot of platforms that are out there. If all of a sudden the overall amount of revenues taken in, the fee structure drops for the whole industry, isn't that going to put some pressure on the fund families and the people who run this stuff in general? I'm trying to think of the consequences of this if it becomes successful down the road.
I mean, I think the market is already pricing that in, Bob. If you look at the PE ratios for a lot of the actively managed mutual fund complexes, I mean, single-digit PE ratios, and it's been that way for a number of years. So I think the market is telling the mutual fund industry, like, hey, you need to get on the ball here and, get involved in the ETF ecosystem in one shape or form, and ANTS is one way to do it. I do think that you're going to need distribution and performance, for that product to raise assets. So you'll kind of know what type of firm you have if you are able to successfully raise assets, because I don't think anyone's going to buy it unless you either have strong distribution or really good performance. So those two, I think, are the crucial things.
Well, Ed, you're in this business for a long time. You've been in the mutual fund business as well. Do you understand what I'm saying? If this is successful, what if you get wildly successful and active fund managers go to the ETF space, overall fees are going to come down. I'm just talking philosophically. Those high fee mutual funds pay for a lot of things, pay for a lot of platforms that are out there. Is there going to be an impact as a result if they become really successful?
Well, I think everyone's going to have to relook at eventually if these are super successful business models. And I don't mean just the mutual fund companies themselves. I mean all of the platforms that the mutual funds are on. The ETFs themselves, if they become highly successful, it predicates, one, client's choice, but two, you're not necessarily repricing a business, because ETFs are very different when you look at how much they cost to run across the board versus a mutual fund. So those differences have to be taken into account, because the clients that prefer the mutual fund may just need that structure for certain things. But you are right in the one aspect, whereas platforms and sponsors will have to relook at everything as time goes on if these are highly successful, which our hope is obviously they will be.
Yeah, I think it's a good example. Be careful what you wish for. I hope they will be successful, but I can't help but think if they are, 65 basis points versus 45, and I think I think there could be a lot bigger differences, and that's going to have an impact. Ed, let me just close with you. We saw some dislocations, and we talked about this last week, between the net asset values of some of the corporate bond ETFs and the prices of the ETFs diverging a bit, a discount for the ETFs. I guess philosophically, where are we on this? What will the upshot of this be in the postmortem? We have the usual ETF haters out there saying, aha, you see, this is the problem. But for those of us who watch this, the problem wasn't the ETF pricing. The ETF pricing got it right. The problem was the way they price bonds, or the fact that they don't price bonds and they don't trade. Can you see anything down the line of how this is going to, will this improve bond trading, move to electronic bond trading? What's the upshot? Give us just 20 seconds on this before we let you go.
I mean, my hope, truthfully here, Bob, is that, at some point this causes bond trading to have more transparency. The ETF is the reflection of the true price, because the firms that are quoting it need that underlying price to really know how to price the bond and price all of the bonds in the basket. The problem with the funds is obviously they don't price every day, and they're using some type of pricing service where they're questioning it. And the hope that this brings to is you will have more of a public market as we go forward. It was kind of the same thought after 2008 and 2009 that the NYSE had considered doing, and I know they have some type of public exchange that's not used highly, but how do you really bring the bond market into the light and have it look closer to the equity market, I think could be the outcome long term.
Yeah, I agree. Stocks went electronic 20 years ago. Bonds have been protected by a still very active over-the-counter market, which has worked fine. But the world is entering the 21st century, and I think it's time for the bond market to figure out how to do that as well. Feel very strongly about that. Gentlemen, thanks very much for joining us. That does it for this week's ETF Edge. I'm Bob Pisani. My thanks to John and to Ed for joining us today, and thank you for watching. You can watch all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, everybody. Same time, same place.
Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.